Q&A and the panel discussion. So if I can ask all our rest of our panelists, I'm going to introduce one of our brand new panelists who's going to come on now. So first of all, he's a chartered accountant. He's also a proficient and prolific deal maker. He was appointed as the financial director of Liberty 2 Degrees in March 2017. He's responsible for financial risk management, analysis of the capital structure of the planning and record keeping. And before Liberty 2 Degrees, he was a deal maker in real estate investment banking division of Rand Merchant Bank, where he was responsible for originating and implementing various transactions in the property sector. He's currently a member of the South African REIT Association and serves on accounting and JSE committee. And he completed articles at PwC, where he serviced clients in the financial services sector as well. So he's currently the financial director at Liberty 2 Degrees. So please welcome to Jose Snyders onto our panel. So welcome to you, Jose.
Thanks, Neil. Pleasure to be here.
Great. Okay, we're going to get the whole panel on board. Our next new panelist, I'm also going to introduce. He has spent 22 years developing franchise brands, specifically in the food and beverage sector abroad. He's now also part of the IWG group, who's been running successful workspace for over 30 years and grow office spaces network in South Africa. IWG already have 57 franchises in 17 cities and towns, and he's the head of partnership growth for IWG Group, known as Regis Spaces HQ and Signature. Welcome to the panel, Alan van der Westhuizen. First of all, I want to thank all of you for your contribution this morning. I think it's been really, we've gone really from the doom and gloom to, I'm feeling a little bit more positive after Jason and Andrea. And I don't know what it is, Evan, but I know you are a data guy. So you look at the data, you look at things as they really are. But first of all, what I'm going to do is I'm going to start off with you, Jose, because we've given our other keynote presenters an opportunity to chat. And so maybe I think you just tell us a little bit about, if we look at Liberty 2 Degrees, you're the co-owner of some iconic shopping centers. I mean, we're talking Sandton City, Nelson Mandela Square, Eastgate Shopping Center, Melrose Arch, Liberty Midlands Mall, amongst others across the country. I mean, you know, so maybe can you just tell us a little bit, in light of where, you know, we've seen retail being positioned, where and what and how, first of all, how has the COVID-19 lockdown affected you? I mean, I'm sure it has, and maybe you can tell us, but more importantly, how are you dealing with it now?
Thanks, Neil. I think we have been severely impacted, along with everybody else, I guess, in the broader economy. You would have seen from our results presentation a few months ago on our mid-year results that our income for the first half of the year was near 50% down in terms of net property income across the portfolio. Obviously, our assets are very large. We look specifically at large retail, regional and super regional centers as the predominant assets in our portfolio, and those were most severely impacted. A lot of our assets are also located within centralized business districts. I mean, Sandton City is probably 40% of our portfolio, and it's located within the Sandton CBD. And during the lockdown, people weren't coming to work. People were afraid of aggregating, I guess, in communal areas within these malls, and that had a severe impact. More specifically in our portfolio, the tenants that seem to be worse impacted are the smaller guys, specifically restaurants and those involved in the hospitality sector. The approach that we've adopted was to look at our tenant base as a whole and to look at whether the problems that tenants are facing are really stemming from the impact of COVID-19 and just a lack of footfall to the environments and spending, or whether there were signs of difficulty before. I mean, as a landlord, we continually assess our tenant health, both from their financial perspective and whether their business model is working. And I think what we find is that although there has been a big impact from COVID-19, there is also problems that have been existent prior to the pandemic hitting our shores in the retail sector, some of which has been mentioned earlier on in discussion, particularly around SA being overtraded as far as retail centers are concerned. And secondly, I guess the impact of our economy at large, the low growth that we've got, as Urban had pointed out, and the continued negative, I guess, sentiment over the next few years towards the African economy. where we have identified tenants that are strategic to our malls, supported them. Across the portfolio, we've given tenant discounts and deferments and assisted their businesses where we felt it worthwhile to do so. Also to keep our environments alive and to keep the mix of tenancies that we need in the portfolio healthy. I think prior to COVID as well, the trend towards online retail and the requirement to integrate technology into these physical environments has been coming for some time. I think the onset of COVID has added impetus to finding solutions, and we are coming up with a number of initiatives. We don't believe that brick and mortar shopping will disappear altogether, but I think it's imperative that landlords do adapt. Specifically, trends that we've noticed in our portfolio is for smaller format stores than the big boxes that we have traditionally had. I think property is still primarily driven by the catchment area that you are in, the spending power that exists in that area. And when you have well-located malls in good catchment areas, it also serves, I guess, in terms of accessibility. And I think one of the points that Andrea made is that the thinking for large center owners such as ourselves is that we have to integrate logistic solutions into these properties. And although a lot of large retailers are coming up with their own platforms for how they sell online, it's important to note that the majority of tenants in our environments are smaller format line shops, and they don't necessarily have the capital or the expertise to necessarily participate in online retailing the same way the larger format stores and large retailers have. And that is where landlords going forward, I think, will have an important role to play. Thanks.
Okay, great. Thank you for that. Thanks you for clarifying that. I mean, it's a difficult one, but I think thank you for sharing it. Alan, moving over to you, with the trend moving to more people working from home taking off, and does this mean the death of the traditional office with businesses moving to give up or reduce their space? And I mean, there's a lot of businesses also under pressure, fighting to cancel leases, reduce overheads and that kind of stuff. What is your view on that?
Hi, Neil, thanks. It's a question that's come up quite frequently. To be honest, the answer is no. The death of the traditional office, I think what happened with COVID is that a lot of people were forced to stay at home. A lot of companies that and a lot of corporates that might have had were thinking about a remote working strategy and potentially reducing their overheads and operating expenses, were forced into a situation where people had to work from home. So what has happened is that you find a lot of people are digitization has come into play. People have become more open to working online and working remotely, but you have challenges working from home. Your biggest challenges being, as you experienced this morning, is that a stable power supply, which then also affects your Wi-Fi or your internet access, and you have other challenges working from home. You know, you're not your dining room table isn't very conducive to being client facing, and you have dogs and kids in the background. So ultimately, you know, the office will always have a place, albeit less frequently, but there will always be a need for people to access the office automation, the facilities in an office, a boardroom, and I do think that a lot of companies that were thinking about the strategy, COVID has really just been that catalyst to accelerate implementing a remote working strategy. And on that point, Neil, it's not the acronym isn't WFM sort of or WFH, work from home anymore. It's work from anywhere. I think you're muted, Neil.
Yes, I am. In fact, I've got many control systems over here behind you. We got a full team over here, and there's lots of buttons to press, and I'm back on. No, thanks very much for that, Alan, for clarifying that. I think it's a nice analogy that you've used there. Evan, we're going to move over to you, and I'll probably ask you to unmute yourself in the meantime. Evan, when I ask you this question, and the question is from Ross Mahoney, and he says, I would like Mr. Rode's opinion. I've seen firsthand in the market that we should start to subdivide industrial and commercial markets into segments with regards to size. And I'm sure maybe also Andre would like to. Reason for this, smaller properties at this time in industrial, for instance, can achieve a higher per square meter rate than a bigger property due to demand. So is that a trend that you perhaps seeing that there is subdivisions of industrial and commercial properties into segments, into smaller sizes? And maybe I'll bring in Andrea. You're welcome to contribute there. Evan?
I think Andrea must answer that one.
Okay. Well, I mean, if you look at our reporting, I mean, we've divided our portfolio effectively into 4 categories. The first category would be a single face, which basically means that you've got your box with everything on one face where the doors are effectively, and that we call just a generalist warehouse basically. And what we have on those though is also a very low office component. Normally somewhere between 5 and 7% of the GLA would be office. Then the second category we have is what we would call and define as a campus, which would be a similar type warehouse, but the office component could be anything from 15 to 20% of the GLA. And the consequence of that is that it also potentially acts as a head office for an operator and not just a warehouse. And we have different, and the rental that you'll achieve across the GLA will be very different, because as you can imagine, to fit out an office component as opposed to a shed component, the pricing is very, very different. The third element, which is obviously a very new element in South Africa, but is a very common element in the UK, would be the last mile delivery platform, which would invariably be a warehouse which would have yard on 3 sides, and would basically be a building that's built with an immense amount of doors. It would almost have no walls. The walls all the way around the building would actually be doors, so that you can load hundreds of trucks at the same time. These kind of properties also don't tend to have massive height, because very little warehousing actually happens in them. They basically be sortation buildings where product would be brought in bulk, would be broken up, and then be reloaded to go and be delivered to final destination. Now, the consequence of obviously a very low site cover means you still have to pay for the land, but your GLA is very small relative to the cost. So your rentals on that particular warehouse would be substantially higher than any of the above as well. In the UK, they've conquered this by creating what they call a factor. So what you'd do is you'd have your base rent, and then you'd multiply it by the factor, and the factor would come out of the cost of the land. Because obviously, depending on where you are, if you're at Heathrow, for instance, your factor could be 4, whereas if you're in Bristol, your factor could be 1.6 or 1.7, because the availability of land is just different. And land in, I mean, if you see recently, I mean, Segro just bought some stuff in Canning at 2.5% yield, basically for redevelopment at £10 million an acre, which basically is £10 million for 4,000 square meters of land. So to make that work, you've got to achieve a proper rental, basically. Yeah. So that's how we divide it. And then we have other, which would be everything else that sort of maybe falls into a historic industrial property sort of definition. So that's how we would subcategorize our portfolio, because we often get questions around, but your rental on this building is so high, why is it? And the reason for it is because the cost of delivery is very different depending on the product that you're developing.
Okay, great. Thanks for clarifying that. Okay, Evan, so I think you got away from that question, but there's one actually on residential. It's from an anonymous attendee, and it's a question for Mr. Rode. So, Mr. Rode, you mentioned that residential properties are still technically expensive. Is this driven by demand for residential properties as a result of work from home strategies, amongst other factors, or do you anticipate a downturn in residential prices in the short to medium term, similar to what we have seen with the other property sectors? What are your views on that?
Yeah, of course, the recent COVID experience has got nothing to do with this trend. It's a long-term trend that we've had for some time, many years. We were lucky in South Africa. We didn't have the complete crash that the Americans, for instance, had in 2008. And the reason for that was our banks were more conservative. They were not as naughty as the Americans. They were terribly naughty, the Americans, and they still are. And so COVID had nothing to do with it. This is the trend. You see, as I explained, property is different from a can of beans. It lasts much longer. It lasts 50 years, 60, 70, 100 years, provided you maintain it properly. So it takes a lot of time for the cycle to complete itself because of this. It's only demand that is of influence there. Of course, when you go into a situation where you drop interest rates all of a sudden, short-term interest rates, then in the short term, it makes houses more affordable, not so. So then this trend could temporarily be stalled, and you could have a short uptick in the real terms in the house prices. But given the prognosis for the SA economy and what we know what's going to happen to our consumers, layoffs, lower salaries, unemployment growing, it's a very easy forecast to say that in real terms, house prices will keep on coming down. But real terms, I mean, having taken out building costs or even CPI inflation.
Great, thanks for that, Evan. Okay, there's a lot of questions which are flying through. Jason, I want to bring you in over here because Jason, you were definitely a lot upbeat. But the interesting thing is, you seem to be in a very specialized sort of retail space, and you mentioned some of the areas, the Alex Mall, Pola Mall, and I mean your trading density 49%. Growth. I mean, that's unbelievable. And 11% increase in turnover. What are you doing that is different? What do you attribute that to? I mean, there's got to be, is there a trend that you picked up that you just have the right location, or what are your thoughts around that in terms of what are you getting right?
Well, I think, yeah. So I would like to say that the 49% is indicative, across the entire portfolio. It is the 11% is across the entire portfolio, so they're not all that good. The 49% one is a new mall, so I would imagine I would perceive that to be as a result of changing shopping patterns. Perhaps the lockdown caused a lot more people to be forced to shop with us, rather than going into Zanin, which is the main urban center, about 65 kilometers, where they previously would have done a lot of their shopping. And then people having experienced shopping there as a consequence of the lockdown, perhaps realizing it's actually quite a pleasant experience on that isolated. But the old adage, location. I think the locations are good. The interesting thing about the sector in which we operate is we're kind of crossover in terms of shopping centers that are both convenient and serve a regional purpose. Because they're close to where the people are, the only other alternative is often 10, 20, 30, 40 bucks one way in a taxi. And so kind of we go across the traditional hierarchies of shopping centers. So, I can't put it down to one thing. I think it's everything. And there's no doubt, as I did mention, that COVID has brought us a lot closer to our communities. Everything that we've done has been focused around looking after the communities, making sure that they stayed safe. So perhaps that had something to do with it. But at the end of the day, because we're in the lower sector of the economy, everything is price driven. So I would imagine very much so that, particularly in our more rural areas, the desire to go and spend $100 on a round trip to get to the major urban centre kind of is outweighed by what that $100 can add into a shopping trolley. So if I was to say one thing, it's possibly that. Although I would love to say it's because of our superb asset and facilities management, but it's probably more economic driven.
No, absolutely. But it seems, look, you're definitely looking after an area that's underserved. Do you think that's a possible trend going forward, that we will see more of those kind of shopping centres closer to those people in the townships?
I think it's a trend that's been, when I launched that, the project development division back in 2008, because in response to myself seeing a lot more people coming in, I suppose it was 2008 was really, the GFC was happening then. But, I think in 2005, 6, 7, if you owned a piece of property, you could let it to a retailer. That was just the nature of the economy at the time. So there was this huge deluge of developers coming in, have land, will develop. It has been a trend that we've seen, a lot more competition coming in, but it's certainly not a slam dunk. A lot of our properties have taken us and are still taking us in excess of 10 years to put together because of various issues. So it's certainly, I'd love to say there's a get-rich-quick scheme in the township and rural, but it's, to get where we've got today, it's taken us 40 years. And as I say, a lot of these projects that we're rolling out now have taken us in excess of closer to 10 years, normally closer to 10 than to 4 or 5 always.
Wonderful. Great. I'm going to bring in Jose. Jose, you're very quiet on that. So there's a question around REITs, and some REITs are trading at huge discounts to net asset value. Is this an opportunity, or do you believe that they may be on the same path? And they mention Into properties. And we know what happened with Into properties in the UK, the majority. What are your thoughts around that there, Jose?
Thanks, Neil. I saw in one of the polls, the results came out, and some people still had some appetite for investing in REITs. I think across the sector, one can say it is cheap at these kinds of discount levels. I think different to what happened at Into. Although some of our REITs are a bit highly geared, we certainly are nowhere near the kind of stress levels that Into had seen prior to its demise. And there will also be different consequences for different REITs. I don't think that the sector as a whole will go down that road. Some are more diversified than others, and some are in better locations than others and have better tenant profiles. So yes, I do think REITs are cheap at the moment. I don't necessarily think the bounce back is going to be to historical highs overnight. I think it's going to be a process of between 2 to 5 years, depending on where you are placed, and how quickly you can evolve to a changing environment. But I do think there's value to be had, yes.
Okay, excellent. Well, that's good to hear. Alan, I'm going to bring in you here. There's quite a few questions around the declining office market. And they're saying that in the declining office market, there's limited information available on whether co-working spaces are a viable alternative to traditional office space in South Africa. What is your view on co-working space in South Africa? You want to maybe just elaborate on that one? Quite a tough one.
Thanks, Neil. Yeah, our opinion is that co-working is growing, and that's supported by sort of the inquiries that we get, and particularly in our suburban locations, our locations outside of the main metro areas. We have situations in Rustenburg and Nelspruit where our centres are sitting at anywhere between 90 and 100% occupancy. So I think that co-working offers a lot of benefits to the small SMME, but also it offers a lot of benefits to the big enterprises or the big corporates that are adopting that sort of hub and spoke model. So they'll have a central office, but then for their representatives or their local staff in the smaller towns, it makes a lot more sense just to operate out of a co-working space. So there's efficiency, there's flexibility. The nice thing about co-working is that you're not shackled to a long-term lease. You could take a day office, you could take a monthly contract, you could take a 6-month contract. So and the nice thing as well is that you don't incur the cost of the fit out. So if you have to ask what my opinion is, co-working is certainly one of the big solutions to that declining occupancy that Erwin Rode was speaking about earlier in the commercial office space, because it's difficult, particularly when the economy is restrained. It's difficult to find the tenant who's going to take up the big floor plate. But if you subdivide that and put it into smaller spaces, and you take it away from being a traditional sort of square meterage transaction, and you're adding services and value to it, you've already got the table and the chair and the telephone. You literally need to walk in with your computer and you can start working. You can scale up quickly, you can scale down quickly. So I think that it's a huge solution to the challenges that the commercial office space is facing at the moment.
I think there's also the other question of fragmenting staff, because there was actually a question around that. And how do you build a culture in a company? And, how do you control and put control mechanisms and keep that culture going? I mean, there's also that question.
Yeah. So, Neil, I think corporate culture is generally, it is nurtured sort of within that office environment, and when you have that collaboration and you interact in person. But I don't think it's restricted to bricks and mortar. I think corporate culture, traditionally you would certainly have a head office or an HQ or whatever that would determine that corporate culture. But I think that allowing people a better or more flexible work environment actually contributes to that corporate culture. And it also talks to how a lot of corporates are advancing and adopting digitization and evolving the traditional models. Just to shoot off a few figures, millennials make up a big component of our workforce, particularly the office-intensive workforce. And 69% of those would trade off work benefits just to have a better or more convenient workplace. JLL, they predict that 30% of corporate real estate will be flexible by the year 2030. And global professionals, they say 53% of global professionals at the moment are working remotely or sort of in a more flexible environment at least half their week.
Wow, that's quite a high stat. I didn't realize it's quite significant. And but yeah, the conversation continues. I'm going to bring in you, Andrea. Taking into account the macroeconomic situation in South Africa, why would you be increasing investment here in South Africa as opposed to the UK? Because I know you alluded to the UK quite a lot in your presentation, because obviously you invested there, so we can understand that. So the question is, why would you be increasing investment here in South Africa as opposed to the UK?
Ultimately, I mean, we're a South African company. This is our bread and butter here. So I do still think that, especially in the sector that we operate in, that opportunities will arise. We're extremely excited about our joint venture with Shoprite. I think there's potential for deal flow in that relationship, which will enhance both Shoprite's improved supply chain and e-commerce penetration and just general trading opportunity, but at the same time will be massively beneficial to us. Over and above that, I think there's more and more of the retailers are seriously considering some technological uplifts of their supply chain to meet the demands that are going to coming through. So, it is doom and gloom at the moment. South Africa doesn't look like you know, the GDP is going to grow and whatever. But ultimately, if we do get a bit of GDP, you know, hopefully it'll fuel a little bit of inflation as well, which will make some of the historic rents that have been growing become more normalized, if you like, obviously. So we still see massive opportunity. I mean, you know, you've got the likes of DSV, which is the 6th biggest 3PL company in the world. I mean, they're a Danish company. They're a massive organization. They've just committed to building over 200,000 square meters of brand new facilities for them to enter the next 10 years of their life in South Africa on the front foot. I mean, the reality is they're probably going to build another 40 or 50,000 in the KZN market. You know, so there are spirals of opportunity. It's just how do you get them? I mean, as you're aware, I mean, we were going to do the joint venture with PEP with their new 126,000 square meter facility up in Hammersdale. You know, so those substantial investments in these mega warehouses with massive technology in them and approaching, you know, the new decade, they're there. There's not many of them, and the competition for them is obviously very, very, very tough. So that's where, you know, we will always have an allocation of our budget for opportunities in SA. You know, but yeah, the quantum of opportunity available to us in the UK over the next 3 to 5 years, in all likelihood, will far outstrip the opportunity that we'll have in South Africa. But where opportunity arises in South Africa, we welcome it with open arms. We still see good upside over a 10-year horizon in SA.
Oh, that's great to hear. That's wonderful, and very encouraging, I think, for South Africa per se. Evan, I want to bring you in here. It's related to there's a question around the national capitalization rate, and particularly on your particular slide, it shows an upward trend. Where do you think it can go in this particular cycle? Would it be as high as 2002 and 3 per your slide? What are your views on that, Evan?
Oh, that's a very good question. Look, the most important drivers of capitalization rates are prospects for cash flow growth, and you can use for that a proxy is the real GDP growth, right? And the other important one is long bond yields. And long bond yields we know have been growing. And why long bond yields? It's because it's a competitive investment. It competes with property in a certain sense. So these are the two ones. And I would like to mention this is very important, that there's no direct one-to-one relationship between long bond yields and capitalization rates, for the obvious reason that it's not the only determinant. As I said, the other determinant is prospective growth in your cash flow. There's a third one which I think we should start considering, and this is that with the poor rating of your listed property sector. Remember, they were the most important buyers of directly held property, and when they had a good rating, they could afford to pay more, all other things being equal, than when they have a poor rating as they now have, right? So these are the three factors I would suggest are driving capitalization rates, and it's a long way to answer the question. But look at having regard to those three factors. I think 2022 is not a bad guess for the top of the cycle, provided, and this is the big proviso, provided the government does the right thing now. If the government is not going to do the right thing now, more specifically curtail the public sector's salary bill, then they're just going to postpone the day of reckoning. In other words, they're going to kick down the road this can, as the Americans say. And in that case, of course, the top of the capitalization rate cycle will be later. But that's a very bad scenario, of course. We call it the IMF scenario.
Okay, thanks for clarifying that, Evan. Jason and Jose, the two J's, I'm going to bring you both in here. There's a couple of questions, they're general ones, but and I think it's one which says, what will the key problems, challenges be faced by landlords over the next 12 months in their respective sectors where they have property holdings? That's the first one. And maybe you can give us the upsides as well. We don't want to just see the challenges. Let's look at the upside. And then the secondary part of the question is related to, given the weak state of local government finances, is it likely developers and landlords will start to push back on continual rates and municipal increases? We seem to be on an unsustainable trajectory. So Jason, maybe the first one for you is the key problems, challenges, but maybe also the upsides faced by landlords over the next 12 months.
So the key problems the next 12 months, rates and taxes, to be honest. So no, the key problems the next 2 months, the security. We were seeing an unprecedented rise in security incursions, break-ins, obviously with the depressed economy, a lot of opportunism. So it's been a big problem for us that we're handling at the moment. We're making some good breakthroughs, and surprisingly, all of a sudden we're seeing really SAPs getting involved. We've broken a number of gangs where SAPs have been involved, bad cops, and we're working well with the good cops. So there's some positivity. I think we've broken four gangs at the moment. Rates and taxes, without a doubt, I think the biggest concern for all of us at Exemplar, because generally speaking, defunct bankrupt municipalities kind of back solve the gap in the hole in their budgets, and they say, well, who are we going to charge? And the big shiny mall in the rural area looks like the easiest, softest target, so we're just going to double their rates. So we're fully cognizant of the rent is just a portion of the occupational costs that our tenants do pay. So every single one of the when they do jack up the rates and taxes, we do fight it tooth and nail, as if it was ultimately it is our own money that we are fighting for, because if tenants have to pay government absurd rates and taxes, they can afford to pay us less rent. So it's definitely, without a doubt, rates and taxes are a big concern, particularly in areas where we get no support from government. So we have our own sewage, we have our own water, we have our own refuse collection, and we have Eskom power, and the municipalities just kind of doubles your rates, and you're like, well, what service are we being given? And none in reality. So it is becoming a problem. It is something that we are working very hard on. But there's only so much within the legal prescripts that one can do. So certainly we don't have all the answers, but within the legislative frameworks, we do whatever we can to make sure that we counter any of those increases. I don't know, Jose, maybe you want to come in, and I'll come in with some more problems.
Yeah, Jose, do you want to, and also open up to Andrea if you got some thoughts on it, and even I'm not sure Alan or Evan on that point.
Thanks, Neil. I think the biggest issue, if I had to sum it up into one area, is probably uncertainty over the next while. There's uncertainty in terms of what South Africa's future is, and that has its own consequence for foreign investors coming into our economy, which is what we need. Policy direction from government seems to be going up and down in various directions over time. Political stability and obviously the increase in unemployment over the next while will affect everybody that depends on consumer spend for years to come. I think the opportunities that come out of this environment is that the right companies will survive. Where there were problems before, some of those problems will be weeded out, and the right tenants will benefit ultimately as the weaker ones fall away. There definitely has been, in my view, a significant push, and innovation has come to the fore, where people are a lot more innovative and brave compared to where they were maybe 2 or 3 years ago in terms of what entrepreneurial opportunities they are prepared to pursue. And I think overall we also have to recognize that government, although there are still many issues over the last while, definitely seems to be making some inroads in at least deciding in which direction the country needs to go and what our policy positions are. And hopefully that ultimately gets cemented into hard actions on the ground. I've been saying at all of our results presentations for the last 3 years that the increase in utility costs and rates are unsustainable for the property sector at large, and is something that we as a sector have been discussing internally amongst various forums such as SAPOA and the Council of Shopping Centres, etc. But we haven't yet made inroads in convincing government and local municipalities to address the issue. And it's affected our property valuations, not only in our portfolio, but more broadly across the sector, and will continue to do so unless addressed. I think there's only so much you can do in terms of adding solar panels and alternative means. Over the short term, the problem is insurmountable. You can't have double-digit expense growth while your income is declining. It's just not sustainable. Thanks.
Andrea, do you want to? How are you dealing with that?
On our side, I think, maybe because we're less glamorous than the shopping centres. I think the shopping centres have really been hit hard on the rates and taxes. I'm not saying that we're not being hit, but I think to a lesser extent. But I think the concerning thing is obviously is that where we go into areas where new parcels of land are being sort of rezoned, and the processes to get these things through, and then to get the approvals, and then we actually have to build all the infrastructure on behalf of the municipality, and the rebates that we should be getting, then don't get paid back, and so ultimately there's an inefficiency in the system, which obviously the entrepreneurial side of what we do drives us to carry on pushing these processes and getting them done, but at the same time, you're paying these rates and taxes, and you're really not getting much for your buck, and you're trying to get plans approved, SDPs approved, and you have the lone rangers in the organisations of the municipalities that really try their best. But sometimes the support from above is non-existent, and that obviously a very concerning thing, and it's getting progressively worse. And you can't wait a year to have plans approved. Your holding costs are just too substantial. So that for us is very concerning. And the other element that's concerning for us, obviously, is that our construction industry is being decimated. The quality of skills, a lot of it is leaving the country. The consequence of which is that if we do get some GDP growth, which we all hope for, is that the construction industry basically won't be big enough to cater to everybody's demands. And one thing that I'm concerned about is over the next 3 to 5 years, is that the construction inflation potentially might go through the roof as a consequence of a supply and demand factor, especially if GDP does, we really hope that Ramaphosa's shovel-ready infrastructure projects actually do materialize, and that money starts going back into the economy and gives a shot into the arm to the construction industry, because they desperately need it. The consequence of it is that there's a lot less construction companies around today that can fulfill the type of projects that we need fulfilled than there were 10 years ago. Let's put it that way.
There's a question around special economic zones impact on industrial markets, as it provides competitive rental, safety, and also tax incentives. Example, company tax 15%. Finding thus low uptake in surrounding industrial areas. Your comments around that, Andrea? And maybe, Evan, you can also comment on that.
Yeah, I mean, we in terms of the client base that we've dealt with, we haven't really seen much of it. These zones have taken, firstly, a long time to get established, and secondly, they're obviously established in areas where the greater consumer isn't present, if you like. And so, I mean, we haven't done one transaction that has been dictated to by an economic zone, and which is obviously not positive. invariably some of these economic zones obviously are potentially driving more manufacturing type concerns, and that's not really a sector that we would operate in. So we may sort of be on the fringes of it. On the logistics side, the guys need to be as close to market, as close to harbour, and that's really the drivers, way more so than any tax incentive at the moment.
Alan, I'm going to bring you. Do you want to? Okay, just if you could just unmute yourself, please, Evan. I could see you wanted to comment there as well.
I would just like to add, I haven't kept up with the exact regulations pertaining to special economic zones, but from what I remember is one of the problems is that we tackled it sort of half-heartedly. When you want a special economic zone to be successful, you need to give it serious benefits like no minimum wages and tax reductions and things like that, And from my memory, and please, I'm under correction, from my memory, we did very half-heartedly when we introduced these things. So, and that explains why they haven't really taken off in a serious way.
So I'm going to bring you in here, Alan. Now, we've seen in the residential sector that there's been quite a shift to the more sub-markets, the sub-sectors, people moving out of the cities into areas like Hermanus, areas like Knysna, George, and up north in KZN into areas like Margate, by the coast and that kind of stuff. Do you believe that creates a sort of a new market sector for offices? Because given what the offering is certainly in the co-working space environment.
Yes, yeah, Neil, absolutely. I think if I refer back to what Jason said earlier, he said that that COVID has taken their retail centres closer to the community. I was quite surprised, Erwin, at the decentralized vacancy rates as high as 12%, but I think that is realistic, and what is happening is that you're getting a lot of the people that used to commute a lot. If I look at with the areas that you're talking about, Hermanus, traditionally people would have to commute into Cape Town to access sort of the head office, and people in George would get on a plane and fly to Cape Town or fly to Johannesburg, where it's quite inefficient and quite costly, and you could work as efficiently if you were working remotely from that area. But just you obviously have to have the right platforms to be able to do that. So having the correct office environment, having stable internet access, having power supply, and just having an office environment that is also collaborative and interactive. A lot of people like to get into the office and have a chat around the coffee machine or the printer or whatever, but you don't have to travel from George to Joburg to do that. You can do that in George, and you can and still have that environment. And I think what it does is it forces us to become a lot more cost conscious. To a large extent, it also makes us a bit more sort of environmentally conscious. Our carbon footprint is lessened by the amount of time that we travel, and there's a lot of advantages to the local community, because if I live in Hermanus and I don't have to travel into Cape Town, then my spending patterns are concentrated within that local community. And potentially, if I'm a small business owner and I'm operating out of Hermanus, then I will employ people from the local community. So there's a lot of advantages to sort of that decentralization. There's a lot of advantages to taking the flexible office environment into the non-metro areas.
Excellent, great. So there are opportunities out there, guys. It's so first of all, we are coming close to the end of the webinar, and I will ask each one of you to give a little bit of a wrap up at the end, to leave some final thoughts. There's a general question though, and it's not always the most uplifting ones, because we know that there are a lot of challenges, and I think Evan did describe a lot of them this morning. And it's really, how do we deal with it? And I think, Jason, from your side, it was very uplifting to see what you're doing despite all the challenges. So it's a question for everybody. I'm going to throw it out to the panel, and then I'll say, well, this is the final one before we do the full round and how we end off over here. And it's pertaining to the bureaucracy in government and the city council. And what kind of support would you recommend that our government would be possible to implement? And it might be very different in Cape Town to Johannesburg, because we still got a DA government running Cape Town and Johannesburg. So, but it doesn't necessarily mean the one is better than the other. They still have bureaucracy, and they still have their challenges on both sides. So I'm just going to throw it out to the panel out there. And in fact, Andrea, they actually asked you to comment first. So maybe you can give us your views, maybe from your perspective, and then I'll throw that up to the rest of the panel in terms of that. And Jason, I think, Jason, I asked you first, didn't I? Then Andrea. So Jason and then Andrea, if you don't mind.
Yes, I tell you what. Coming out of Molotembiso, it took us a year and a half to get our plans approved. So we're still bitten by the pain of and there were really, there was no reason for them not to approve our plans other than people were looking for something. And because we don't do that, the reality is we had our plans held back. So yeah, it's I've still got a bitter taste in my mouth. So I'm not going to come up with too much positivity other than to say, really, if government would just let business do their work. Government is not meant to be an employer. They are meant to create an environment that is conducive for private enterprise to create job opportunities. So, from my side, if they would just do less, get less involved and just do what they're actually paid to do. I'm maybe sound a little bit bitter and twisted, but it's because we've had to go through a lot of pain to get Tembisa through the gates. To get taking 18 months to get plans approved, which should have been approved within 60 days. It's a painful thing, and when you're creating 2,000 to 2,500 jobs in an environment where the government is, where the president has said a call to action, let's get jobs going, and here was a quick win, an easy win, and we were literally obstructed from doing our job because there were self-interest groups. I don't have any answers other than to say it would just be nice for government to do their job, really.
Well, yeah, Jason, I think it's important to make your voice heard out there, and hopefully, somewhere out in government say, yes, we do hear you, Jason. Andrea, your thoughts there?
Well, I mentioned it earlier. We've had occasions where it's taken more than a year to get plans approved, and it's disgraceful. And believe it or not, that was in Cape Town. So the DA is not immune. In fact, the DA is probably, in some instances, the biggest culprit of it, because they have this high almighty sometimes attitude that they think they're better than the rest of the country. But yeah, so I'll be honest with you, our best experiences happened to be in Ekurhuleni, which is the same council that Jason was talking not very well, but yeah, our worst experiences have been in Cape Town. Our second worst, the city of Joburg, and Ekurhuleni have been the best of the bunch. But I suppose it does vary. In Ekurhuleni, we went through a massive rezoning process where we presented a platform of development and potential work in the area, which was substantial. But we're talking beyond the development, future employment, and we had the powers that be that were very much in our favor. So the powers that be showed their leadership in this instance, and they facilitated a process which got certain approvals done in record time, and we were obviously very positively surprised. And I think that's really what it comes down to at the end of the day. I think the quality of leadership at municipal level is poor, and the poor guys that are at the coalface that cop all the flack from us, unfortunately, so they're sometimes victims of really, really poor leadership above them, and that really where it all really falls apart. If we had good, positive leadership that understood that we were actually there to facilitate positive growth for local communities and environments, and invariably, you know, there are certain people that come through the process that maybe don't follow due process, and so we all get thrown into this tarred sort of vat, if you like, and ultimately, I do think that you know, there are really good developers in this country that have historically over the years, you know, proved themselves, and I think there should be, you know, a credibility rating that you know, in terms of your status, in terms of, you know, the balance sheet that you and how you can stand behind your product, that if something were to go wrong, that there would be recourse. Unfortunately, yeah, that's for me where the problem lies. You need more leadership, and there's just lack of leadership.
Jose, I don't know if you want to just add anything to that, or any of the comments that were made before.
Yeah, thanks, Neil. I think over the last while, there's been a lot of, I guess, attention given to headline-grabbing projects, you know, projects that could be used as political currency. And I think we're not going to move the dial by supporting large projects and large businesses. I think in the short term, there needs to be a focus on a lot of projects that are in the system already as low-hanging fruit. Starting projects afresh on a greenfield basis is not going. It's going to take a lot longer. There are projects out there in our business and in many other businesses that we know of that have been and suffered delays as a consequence of government inefficiency for years on end. And I think the big thing for me is that when we are doing it as large businesses, we've got the resources to appoint professional teams, lawyers, and consultants that can help these things along. Small business owners don't have any of these resources. And whereas we want to create thousands of jobs, the only way you're going to create tens of thousands and hundreds of thousands of jobs is if the small businesses get ahead. And that is where I think government are failing the economy dismally, is in supporting small businesses to get their small projects going. They seem to face a similar level of bureaucracy that large businesses do, and there needs to be a distinction between the two if we do intend changing the trajectory. Thank you.
Great, thanks for that, Jose. And I think what we're going to be doing now is we're going to be closing up the webinar. So I'm going to ask each one of you to give a little bit of a wrap up and sort of a way forward, and probably just to leave the audience with something that they can say, well, this is something that I can take forward in my particular business, whether you know, it's a challenge or an opportunity. But so I'm going to start off with you, Evan, maybe to give a 3 or 4 minute to just wrap up of your final thoughts and yeah, and your parting shots for everybody on this conference today. Just to unmute yourself there, please, Evan. Thank you.
Well, I'm sure you want some good news from me. The good news is that, as was pointed out, there are always little niches in bad times. And I didn't tell you that. We heard today where the niches are. But whether everybody's now going to jump up and start developing big warehouses, 12-meter high warehouses, I somehow doubt it. They're not space for more than a few players. So, I mean, then there are things like student housing. I don't know. I can't get a grip on student housing. The risks are huge because when the government runs out of money, they'll start cutting everywhere. So I can't get this feeling of student housing is heading for a precipice out of my system. I'm not saying it is, but it certainly is a risk factor. So what else is there out there? There are very efficient home builders out there, and we needn't call their names. And they will probably survive this downturn because they are professional and well managed, and they'll still presumably make money. But of course, for them, the biggest risk is the tempo of sales when they do developments. Without a doubt, we all know it's all about the time value of money when you do developments. And so those guys in the home building industry, they must tread very, very carefully because we are heading for, I'm sorry to say it, we're heading for tough times.
Great, thank you, Evan. Alan, I'm going to ask you to give your closing thoughts, your parting shots from your side and from your perspective.
Thanks, Neil. Yeah, I do think that in terms of our sector, specifically the commercial office sector and sort of the flexible co-working sector, I want to emphasize that the office is very much alive. There will always be a place. I think what it's going through is sort of that sort of metamorphosis now, or that it's just going through quite a noticeable evolution. And it's an exciting time because it's allowing people to be a bit more creative. It's fostering a lot of entrepreneurial spirit. It's allowing people to work from anywhere. So it opens up a lot of doors. I think that from our side, we are excited to see the office decentralizing and going into the suburban locations, into the smaller towns and cities, the non-metro areas. There's big opportunity on our side, not only to grow our footprint, but to create employment opportunity, to create investment opportunity. We're looking for partners on our side to sort of to take our brands into those smaller towns and cities. So we are positive. We're not ignorant to the fact that there will always be certain challenges, but at the same time, I think it's sort of how adaptable you are as a business to be able to just course correct, steer the rudder so that you can take advantage of what's going on in the economy.
Excellent. And a nice way to end off there, Alan. Thank you very much for your contribution today. And I'm now going to ask for Jose, if you could give us your wrap up there, please, Jose. Your thoughts, your final thoughts, maybe give something positive, something good, something great.
Neil, I think it's important to give more energy to the positive outlook than the negative. It's all relative at the end of the day. If every individual in the world lost half his wealth, we'd all still be in the same place, but you'd feel poorer. It's kind of the analogy I like to tell people. I think there is a lot of positives that we can look forward to. We have had difficulty as a country, but again, there are many countries in the world that are in similar dire straits at the moment. And I guess what'll emerge is that the guys who are more innovative, harder working, and live the principles that they'd like to see enacted in government will make a contribution. And I think it's incumbent on us as business people and as people leading organizations to do so and to play our part. Thanks.
Thank you very much for your contribution today, Jose, and thank you for filling in for Amelia. I know it was a bit of last minute, she threw you in, but I would expect that from your boss, being the financial director of a big company, when she's got to move, you've got to jump. And so, but thank you. I think your insights have been fantastic. All right, so next, Jason, give us your final thoughts. I mean, you're a positive guy, so I'm looking forward to your final thoughts. And then you fought through a lot of challenges, and so yeah, leave the audience with something really good that says, "Wow, things are not so bad if I do this or that." Yeah, your thoughts, please, and your parting.
Yeah, well, I wouldn't say I'm a positive guy because I'm just by nature a positive guy. I'm a positive guy because I've got a positive team around me doing positive things. So yeah, I'm uplifted by the people I work with and the things that we're doing. We do positive things. I think my one takeaway is, with all the doom and gloom around, you've got to look local. And I think what we're doing at all of Tembisa, I hope a couple of you guys will follow us, see what we're doing, and how we're empowering local business. We've gone a long way. It's one thing I should forgot to mention in the discussion that we're having, how we are really focused on local entrepreneurs, giving local up-and-coming retailers, startups, space to shine, local food markets, local community growers, local hawkers, farmers markets, that kind of thing. We've got a saying here that local is lacquer, but Kazi is king. And we've always focused on creating local economic empowerment, local economic growth around our shopping centres, by employing local people and really investing in the local economy. So don't be looking overseas like everyone else. I know that Andrea, you focused abroad, and there's a lot of good to be said, but there's a lot of positivity, a lot of creativity locally if we just go out and find it. And people in this conference, people around us are in a fortunate position that we do have the means and the ability to actually create the pedestal for this creativity, but people don't have access to capital, access to market. Find those people, let your light shine on them a bit and give them the light to shine, because in allowing their light to shine, they've got the ability to become a startup that then can create more and more jobs in the local economy. Certainly, we're very, very inspired by what we're seeing on the local level. And certainly, I can't wait for 17 days to arrive, so we can highlight some of this excellence that we've got coming out of Tembisa, and hopefully these initiatives going forward. So there is positivity out of it, out there. You just need to stop listening to everything that Owen says and go and find it.
Thanks, Jason. Thank you for ending off. That's a wonderful high note, and thank you for your contribution. It's been really an eye-opener today, so thank you. Andrea, you got the last word, and purposely, that's why I put Evan up front, so we could get all the negative stuff out the way, and then we could put Andrea on right at the end to give us such an uplifting finish. So the floor is yours. You've got the last word. Probably very powerful position to be in. So over to you, Andrea.
Thanks. Listen, we, as I said earlier, I mean, we truly believe that we are a South African organization, and we do think that opportunities will come in SA. The space we operate in, as Erwin said, it's not everybody that can go and put a 50 to 100,000 square meter box up. I mean, the capital values associated to these projects are substantial. But that being said, I do believe that we've got some amazing developers in our space that we compete with on a daily basis. I think the competition is really, really good. And I do think that some of the product that we put out is best in class. We took a team of our professionals over to the UK at the back end of last year, and we took them to one of the best warehouse builders in the UK, and we took them to our development partners' offices in the UK, and just to sort of give them a broad-based perspective of how they do it there. And the reality is that we came back from that experience where there were probably in equal measure things that we do better than them, as opposed to things that they do better than us. And our teams basically benefited from learning from both aspects of it. And that information has come back to SA. We've incorporated some of it into our current projects. And I do think that some of the product that we're putting out at the moment is really, really good. And there are some outstanding companies out there doing some very, very good work. And there's going to be winners and losers. And we just hope that the winners are on our side and paying rent to us rather than the losers. But invariably, this is a massive shake-up for everybody. But out of it, I think positive will come. And hopefully, our government does show some quality leadership and ensuring that the right platforms are put in place for government not to interfere in the private business. And I think, freeing up the energy industry is obviously a step in the right direction, and hopefully we get much more of that, which will allow the entrepreneurs that are on this panel that represent outstanding businesses in South Africa to do more of what we do well, I think, and what we've done well for many, many years, and hopefully for many, many years to come.
Oh, that's a wonderful way, I think, to end off, Andrea. And thank you for your contribution today. And I'd like to thank every one of the panelists today. I think it's been a fantastic discussion. I think it's been really eye-opening. And while we've got lots of challenges, there are lots of opportunities. So first of all, just by name, I want to thank Evan Rode, the founder of Rode & Associates. He's also one of the co-hosts today. To Jason McCormick, he's the CEO of Exemplar Retail. To Andrea Taverna-Turison, he's the CEO of Equitas Property Fund. Jose Snyders, who's a financial director of Liberty 2 Degrees. And lastly, Alan van der Westhuizen, who's the head of IWG, of Partnership Growth. And that brings us to the end of the webinar. So I want to thank you, the audience, for your participation today. We do have some unanswered questions which were published on the Real Estate Investor magazine. It's a Digimag, it's online, it's for free. You can get it. There's an Ask the Expert section where we'll deal with those questions. If you would like to post some more and you'd like any other questions, we can also put it through to the panel here. Then just post them to info@remag.co.za. There will be conference recording replays. There were some challenges up front. I've got to tell you, we've never had load shedding in the middle of a webinar before, so we had to pull out all the stops to make it happen. So we'll deal with all the recordings. Without electricity, it's quite tough to run something like this remotely. But certainly we managed to make it happen. So I want to thank the team behind also for doing such a great job on that one, where we had to pull out all the stuff. So there will be replays of the webinar that will be sent to all the delegates that signed up for this particular conference. We will send that through to you. And if you want to access some of the delegates who attended, we will send you the full attendee list. You can select the people that you'd like to make contact with, and you let us know. We'll set up an appointment with you. And that will be done on request. So that ends off part 2. Don't forget to join us for part 3 on Tuesday, the 17th of November. That's at 10 o'clock. And we're going to be talking about the state and prospects for the residential property market. So that's going to be interesting. And we've got an interesting panel from the bankers through to the developers in the township markets, to the big developers. And of course, we've got REI RODE, and we've got giving his views of the market as well, and very interesting. So we encourage you to join us for that. There is a link on the bottom. Of course, we've got a free webinar for estate agents and brokers. It's a PropTech webinar, which is going to be on the 25th of November. That's a free one, which we do twice a month in any event, and we look forward to seeing you on that. So I just want to end off with an inspirational quote from industrialist billionaire Andrew Carnegie. He said, "The wise young man or wage earner of today invests his money in real estate." So we just confirm with what Andrea of Equitas and Jason of Exemplar have said to us today. So yes, so thank you very much. Thank you for joining us today. We look forward to seeing you in 2 weeks' time for our final conference leg. It's part 3. The virtual property conference on Tuesday, 17th of November. We'll see you there. And for all of us, this is Neil Peterson of Real Estate Investor RODE Virtual Property Conference signing out. And the message is stay safe and successful investing.